Are we live now, are we?
We are live. Hello to the masses.
Hello, hello.
It's so weird looking at it, like the lag on it.
Live now, are we?
We are live. Hello to the masses.
Oh, hello, hello. Okay, so we'll kick off in a few minutes, yeah? While everyone joins.
Yep. Mike, just checking you remember those stats?
Yeah.
Okay.
It's actually my Friday today.
Oh, yeah?
Technically, I'm flying down to Christchurch, day off tomorrow to visit my brother and some rallies. My nephews. Should be nice.
Yeah.
First flight for Seb.
Oh.
Yeah, so that'll be interesting. See how it goes.
I mean, questionable destination, I'm going to say, but,
No, Christchurch is great.
This is not going to surprise anyone. I've never been to Christchurch.
What? Oh, how can you say it's questionable?
Mike's first proper time in Queenstown was for my wedding.
You're joking. Just the other day.
I've been there once before, but only at night for a stag party. Like, I've flown in, gone out to Wanaka, and then come back for a stag and gone back to Wanaka for the wedding. But like, I don't ski or snowboard, so it's never been like a destination for me, really. And also, we've got a farm up the top of the North Island, so we just go north and go to the beach, right? Like, so
Fair enough.
That's actually what I'm doing this weekend. I'm going out there to that storm that just rolled through. I got to go out there and fix a whole lot of stuff because, like,
oh really?
Yeah, apparently it's pretty wild up there.
Yeah, right.
Not major stuff, just like fences and trellis and stuff like that, but trees.
Are you a fisherman? Do you go fishing?
Kind of. Like, I can.
Like, I mean, technically, I mean, doesn't have the skills, but technically could throw a rod out, right?
I've got the skills, then. I'll stand by that, actually.
Yeah. We interviewed somebody for a role today, Luke, and he only hunts. Eats what he kills.
Yeah.
It's becoming quite a thing, eh?
Yeah.
I
don't have the stomach for it.
Well, if you can afford to have all the gear and go on a hunting trip.
Yeah, he bow hunts, though, which I found quite interesting.
Wow.
Because if you're relying, yeah. But again, he's like, I need to go hunting again because I'm running out of meat. So,
yeah.
Is that a service you provide, is putting that on the balance sheet for clients?
Yeah, I said to him, I was like, where do you go hunting? He said, you're aware. I'm like, mate, pick a better spot. It is horrible hunting in there. Like, you could go like Kiwisaver or something, but that was the extent of my hunting chat, and James didn't call me out, so it was really nice.
Yeah, right. If you are tuning in, welcome. We're going to wait to kick off things at about 2 past the hour. James and Michael have actually validated through data that 80% of Xeros tune in about 2 to 3 minutes late to meetings.
Yeah,
we're all scrambling between our meets, working remotely.
Yeah. Hey, Luke, one other piece of feedback we got in the survey yesterday, which I don't know if we could do, but somebody said it'd be nice to ask anonymous questions. So I'm wondering.
I was thinking that, but YouTube probably doesn't allow that.
Yeah, so I was wondering if like they could send it to you and then you could post it.
Yes, if they're happy to do that.
Are you a judgmental guy?
No. I can offer that.
Okay.
The other thing I was going to say is, why don't they just tee up a session with you that you're offering at the end, right?
Yep.
Because that's there and that's available.
Mm-hmm.
All right. Well, we are. What do you reckon? A minute past. We're 20 and counting. So why don't we'll kick off for the sake of those who are prompt and timely. So welcome, Xeros. Happy Thursday. So this is the third session of a 3-part series that we're running with Lighthouse Financial. Hopefully you haven't been to, well, if you have been to all the sessions, well done, but you've heard the same intro from me, which I'll do again just to introduce the guys and sort of a bit around why we've set this up. So the purpose of these webinars is really to help you make more informed decisions about your financial future. And for me personally, I'm passionate about, I geek out on personal finance, having a budget. Like I track my personal budget and balance sheet in the free Xero subscription we have, and investing's always been a topic of interest outside of work. And I know Michael and James from another life in banking, and I just think the way I actually described it to someone who reached out yesterday and said, hey, I really just enjoyed that session, is Lighthouse they're still professional financial advisors, but they're just a bit more relatable, particularly I think to Xero's demographic, than most of the rest of the industry out there. So Lighthouse are a full financial services firm with accountants, they're mortgage brokers and financial advisors. And James and Mike, who are on the call today, they're both financial advisors with 20 years experience combined. And outside of their day-to-day of helping clients achieve their goals, James and Mike are passionate about helping Kiwis take control of their financial future. So they do this through webinars like we're going to do today, which they've done with businesses like Rocket Lab, Russell McVeigh, Simpson Grierson, WSP, so we're in good company. But they also break down topics in sort of soundbite videos and podcasts called Checks and Balances. So I will give a plug for that. It's really good content. They've got thousands of listeners now each month. So hit the subscribe. They're also on Apple and Spotify for that podcast. What else could I say? Yeah, so like we've had really great demand from Xeros, which is awesome. Probably a sign that you're either really motivated in the new year to get cracking on some goals that you got in place, or you're just freaking out after New Year, like what am I going to do with my money situation? So either way, it's good to have you here, and I'm sure you'll get some good tips and advice. And if you, just for asking questions, log in on YouTube and just type your questions in the comments. That's really where the value is going to come from today, is like listen what they've got to say, but they're going to stay on and just answer each of those questions that are coming through. If you have an anonymous question, you can Slack it to me and I can post it in there myself. And then they also are going to offer a free catch up with Lighthouse Financial at the end that I'll send an email and you can register for that. Guys, before I hand over, I just have a quick joke that I wanted to throw in there. So Batman invited all the superheroes to an evening discussing Bitcoin investments. Superman didn't go because it was crypto night.
Should we end the webinar? Thank you everybody for your time.
You can boot me now. You can throw me off.
All right. I don't even know what do we do after that, Mike?
I don't know. Keep them on.
Keep them on. Hey, we'll just keep them on to crack jokes every
one more joke.
Every few minutes. Yeah. Okay. All right. Hello everybody. I'm James Blair. I'm a financial advisor. Michael is the mortgage broker to the stars and can also be yours if you like. Before we start, if people can just like this video just to make sure that we know you can hear us. And we will crack straight into it. So today is a sad day for you Xeros out there. And it's a sad day because it's the last webinar that we're running for this week. Hopefully there'll be some more in the future. So on Tuesday, we did our first home buyers webinar. On yesterday, we did a mid-career and creating wealth webinar, which leads quite nicely in today around investing 101. And Mike, based off the number of people who have subscribed to this webinar, it seems like this is going to be a pretty popular one. So today is, we will talk probably for about, I don't know, maybe till about 22, something like that. We're going to try and keep it nice and punchy because nobody likes a long, boring presentation. We like to keep things pretty fun, pretty, interesting, while also making sure that you get what you want out of today. So we will talk until that time. And then hopefully what will happen is as we're going, there will be lots of questions building up in the live chat so we can take you through all the answers at the end, or Mike can sit on the fence because sometimes Mike does like to sit on the fence.
Absolutely not.
So at the end of today, we will send you a survey link to let us know how you found this session. Just a really quick thing. This is a webinar based for people in New Zealand. If there are any people overseas watching this, you're probably not going to get what you want out of it. But before we jump into the content, let me quickly say, if you haven't already listened to us on the last 2 days, what have you been doing with your life? If this is the first time, at Lighthouse, we're based in High Street, in the middle of the city. We're a full financial services firm. We do accounting, mortgages, trusts, property, wealth, where we build our own investment portfolios, give advice on investment property. We definitely don't give advice around cryptocurrency, but we will talk about it a little bit today. And we also do life insurance, income protection, etc. Our purpose at Lighthouse is to secure your financial future. So for us, that means thinking long-term, not short-term, buying long-term assets. We believe financial literacy plus action equals financial freedom over time. So today is around literacy. Subscribe to the channel you're on. We've got about 70 videos on different topics. The one that came up this week was around why the market's volatile at the moment. Next week is around the new triple CFA changes for why is it so hard to get a mortgage. And then action is off the back of today. So whether you take that action personally, you book a one-to-one session, all of those things will lead to financial freedom.
Cool. So for everyone who was on our previous webinars, you'll notice that this disclaimer is a bit more beefed up. This is not personalized advice. Do not act on this advice without seeking personalized advice first. We are talking in general terms to provide information on investment options and principles. If you would like to discuss your personal situation, we're happy to book a time and sit down with you. Look, guys, we're going to give you as much information as we can on this webinar. But to be honest, if you want us to talk about like iron butterfly spreads for your investment portfolio or like, you know, your crypto trading bots and these sorts of things, we're not going to give you that today. We're going to give you the fundamentals and some information. There are Reddit forums that cover all that sort of stuff. You don't need us to talk about it.
That's good. Not as good as Luke's joke at the start, but pretty good.
Cool. So guys, our headline stat, why do we do these webinars? Look, 46% of Kiwis are unsure about making, you know, a large financial decision or their financial future. And I've said it before, I'll say it again. If your parents don't teach you about it, if school doesn't teach you about it, how are you meant to know? All of a sudden, one day, you're just expected to know how to buy a house. No one tells you how. What are you going to do? So that's one of the big reasons why we run these webinars, is to increase this percentage. Or decrease this percentage, sorry. So 16 years. What is this? Now, this is the time it will take a property to double with a 5% growth rate. So again, yesterday and the day before, we talked about getting on the property ladder as soon as possible, you know, so you're not priced out. What we're looking at now is from an investment perspective. So what does that mean if you use property as an asset class to invest in, and what can you sort of reasonably expect over the long term? 34%. So that is the capital gains on house prices over the last 5 years in Auckland.
Nice. I thought you were going to get lost there for a second, Mike.
It's got to slow down. And then 1.4 billion, that was the amount of funds that were transferred from growth funds to conservative funds during the last major downturn. So we'll run through this in a bit more detail. James will talk about the investment side of things a bit more, but he'll talk about, you know, what should you do in these situations and what does this actually mean for investors?
Yeah, it's all about trying to time the market.
Of course, yeah. Look, so the agenda today, we'll go through some investing principles. James will cover that off. He'll also look at some investment portfolio stuff. I'll look at property investing and crypto investing, and then we've got some other stuff to tidy up at the end again. Again, on the crypto stuff, guys, we get asked about it every second day. And so we have to give information on it. We're not going to give you advice on this. You don't want my advice on this, because while James and I both hold crypto, I'll tell you a story later, but it hasn't gone well for me.
Yeah, there's probably people on this call who know a lot more about crypto than we do. And that's probably a really good touching point as well, is when you're talking about financial knowledge, financial literacy, is everybody is at a different point. You might know, if you know lots, hopefully you get a couple of things, but this is the idea of today is this is an introduction and some really important principles to think by. Great. So I'm going to talk about before, Mike, I think it's safe to say most people just want to get rich quick, right? They don't want to do the boring. They don't want to slowly drip feed into funds. They want, the outcome. They want the lifestyle as quickly as they can. And
well, if they didn't, Lotto wouldn't be so popular.
Unfortunately, that's not how investing works. If anybody tells you they're going to give you huge returns, like I've said the last 2 days, you should probably run in the other direction. There's no free lunches. If it's too good to be true, it probably is. So this section is all about what are some good rules to live by when investing. These 4 things are buzzwords that you've probably heard us talk about a bit over the last few days, but let me touch on it a little bit more. Goals are before you're looking to invest, and maybe if you're younger, you're not too sure what you're working towards. Maybe you like the idea of freedom in the future, options, that's great. But when you're thinking about where to invest and what to do, your goals are paramount. So I always like to say to people, if you could build the life of your dreams and you didn't have to worry about money, you could do something tomorrow, what would that look like? And then you build it out from there. So essentially you start with the big, ambitious, hairy goal. You put some specific measurable targets around it. And then you work your way all the way back to what can you do today? What are the actions you can take each fortnight to achieve that goal? That links quite well with your time frame as well. So if you are planning goals, if you are setting objectives, you will know how long you have to invest. If you want to buy your first home, or you want to use money for renovations, or you want to go on your OE in 3 months, you probably don't have the time frame to take much risk. If you're investing in property, we want to see people holding property for 10 years plus. If you're investing in shares, we want to see you holding them for 8 to 10 years plus. And that's because we know long-term averages. Anybody who thinks that they can try and time the market, geez, that crystal ball is working overtime at the moment. Risk is a really big one, and risk and returns kind of tie in quite nicely together. And also, risk has probably so many different avenues we could go down as well, Mike. There's concentration risk if you've got all of your money invested in one piece. There's speculative risk where you're looking for huge returns on something with very little with the potential of it going to zero, but hoping for a big number at the end of it. And then there's kind of shorter term risk. So that's where the time frame and the goals become important. But also, if you're investing in just shares and you've got a shares account, which is the top 100 companies in the world in an index fund, you've got to be comfortable that your risk is that it could drop 30% in a global financial crisis. And also remembering with that risk that COVID, markets recovered in like 2 months. Typically, recessions or corrections last for 12 to 18 months. Now, one way to mitigate some of your risk is around diversification. So in New Zealand, we love property. We're learning a little bit more about shares these days as Kiwisaver balances grow and Sharesies becomes a more popular platform and the like. But we need to make sure that we don't have concentration risk around one asset class, one country, one industry in terms of how we're investing. So there's some really basic investing principles.
I think probably a good thing to jump in there on the diversification piece is if you are being sold something by, maybe not by an investment advisor, but by, someone who's selling you an asset class, don't look so disappointed, James. Just remember that, sometimes people will pitch diversification to you that doesn't really, it's not actually there. For example, if I'm just selling properties to people, quite often we'll hear in the market, oh, look, I'm diversified because I've got some in Auckland, some in Wellington, some in Tauranga or something like that. I'm like, you're still investing in New Zealand property. Just keep in mind when people are explaining these sorts of concepts to you about what their vested interest is when they're giving you that advice. Because if you sell hammers, every problem looks like a nail.
That's one. Okay, this is probably a big one at the moment. So a big part of what I do as my job is I have people investing lump sums of money. And the very common question is, so James, what is happening in the market at the moment? James, is now a good time to invest? James, how do you feel about the next 6 months? Trying to time the market is an impossible task. You can try and make a prediction. Maybe you'll be right, maybe you'll be wrong. But just because markets that are at all times low doesn't necessarily mean that they're going to increase in the next 3 months, or just because they're at all times highs doesn't mean it's going to decrease over the next 3 months. Timing the market is one of those things that is impossible to do. And I would strongly recommend that you think about a long-term game and think about time in the market opposed to trying to time the market. Only if I had some data to support this claim. So this is, it looks like somebody's heart rate, obviously.
My heart when giving crypto advice.
Yeah, obviously when Luke's getting to spend some time with us on these webinars, it's, going up, and he's very happy with his life. This is the quarterly performance of a 50-50 portfolio. So half in shares and property, half in cash and bonds. So you can see, can you see my mouse when I do that, Mike?
I'll have to look on YouTube. Nah.
Okay. So when you can see at the start on the left, it's up 10%. Then there's a quarter.
You can see the mouse, but it's just a lag on the YouTube.
Okay. 10%, then it drops to 5%, then it goes up to 10%. Then down here, it's down more than 10%. The point here is, if you're trying to time the market, you tell me the trend. What is the trend here? It is pretty bloody hard to time. So I know Mike's trying to work out the trend. Good luck, Mike.
I'll slap some candlesticks on that and make it look like a trend.
But if you think about investing over 30 years, you can see how much of the risk is mitigated. So instead of trying to time short term and I need the money in and out and I don't like savings rates, I'm trying to make a bit more money, you're investing in, your return is between 8 and 14% on average over a rolling 30-year period. So this is the really important part around people try and get really smart with their investments. They try and get very tactical, but it is just very, very difficult to time the market. So I would strongly recommend you think about time in the market. So on that point, there's not just trying to time the market. Coming back to this diversification piece, different assets perform in different ways over periods of time. So an example I looked up just the other day was the NZX has dropped about 3% over the last 12 months, while the S&P 500 in the US has gone up about 12 or 13%. So you're talking about a 15% differential in terms of performance when both are invested in shares. Now, that obviously becomes even a bigger range of performance when you're thinking about property in New Zealand, global property, commercial, infrastructure, mid-cap shares, emerging markets, cash and bonds. And you can see from 2006 to 2020, up the top is the best performing asset, down the bottom is the worst performing asset. And while some have done well quite a few times, you can also see there was periods of time where they did absolutely horribly. While in 2006, property did 35%, it also dropped 37% in 2008. So some things to think about there, and the point that diversification for a smoother journey over time is very important. Speaking of diversification, here are the 4 traditional asset classes. So you've got cash, bonds, property, and shares. On the right-hand side, they're your more aggressive assets. So they're going to be more volatile, but they're going to deliver a greater return over time. The cash and the bonds will be more steady as she goes, not knock your socks off, but provide more stability. So when you're thinking about your Kiwisaver or your own investment strategy, you should really be thinking about your risk profile, and your risk profile from two ways. One is, how much risk do I need to take to achieve my goals? Because there's also opportunity risk if you don't have enough growth assets in your portfolio, which are property and shares. But also as well, making sure that we've got enough diversification so we're not too dependent on one particular asset class or company or industry doing well.
Quick one. So the less aggressive stuff is on the left side, so the bonds and the cash. I see some bonds though that have a rate of return which is quite high. What's to stop me going, or would you suggest if I was looking for a greater rate of return but with a little bit less risk, would I not just go for a bond that had a higher interest return on it or coupon?
Exceptional question, Michael. So that is what we call a junk bond. So the difference between a bond and a share is bond is like a loan. It's a debt instrument. So I'll lend you some money, then you will pay me interest, and then I will get my money back at the end. A share is going on the journey of whatever the value of the company is. So if you think about it as a loan, you go, well, that sounds lower risk. The only time it's not, doesn't work out very well is if that company or that council or that government, God forbid, were to fall over and you wouldn't get your money back. So if a junk bond is offering you 8% the current market, it means there's quite a lot more risk associated. So sometimes, I'd say a lot of the time, a higher quality share is a much better asset, generally speaking, than a higher percentage bond, because essentially they're taking into consideration the risk of it going pear-shaped.
Yeah.
So these days, there's lots of different ways to invest as well. Traditionally, it was probably more towards that top right corner where you've got your dirty brokers taking their 2-3% rates and then fees and then clipping the typic on the trades on top. I'm just joking. Brokers have a place in the market. No hate to any brokers watching or anybody who knows a broker. The other markets that have started to open up is obviously the direct investing, the online platforms, and then the passive investing as well. So the direct investing can be really good for people who are super interested in what they're doing and want complete control. Couple of counter arguments. Some people have told me they feel like gambling when they're investing in these platforms. So how are you picking what you're investing into? How does it come together as your complete financial situation, opposed to I have a good gut feeling about A2 milk and then it not working out very well. Passive investing can be a really good solution because essentially the fees are really low and you're just sticking it in the market and the market will deliver whatever the market delivers. And then active investing's had a place for a long time in terms of that broker relationship, or a place like Milford where they have higher fees. Maybe you're getting some service, hopefully. And the idea is that you're trying to outperform the market over a long period of time. Now, statistically speaking, it's quite hard to do that. It's quite hard to outperform the market over a long period of time. It's just is what it is. It's hard to outperform the market. The catch to that is thinking, well, what kind of combinations of these three services should I be using? And how do I use a financial advisor to help link an investment towards your goals and making sure you've got peace of mind that you're on track? That's really what an advisor should be doing. You can get an investment from anywhere. It's about the linking of goals and making it personalized for you.
Cool. So property investing. Kiwis absolutely love it. We go nuts for it. What I'm going to cover here is just sort of, I guess, a typical roadmap for property investing. And then a couple more things just around different things to think about, different types of properties and these sorts of things. So a property investing roadmap. Look, for your first property you're going to buy, it's probably going to be your owner occupied property. You put in 10%, 20% deposit in there. If you're focused on a return from that property, it's more likely to be a capital gain focused return than a rental income return at some point. And just to, again, break down the jargon, when I say capital gains, I'm talking about the increase in the value of your house price. The rental return gain, obviously, is the rental income that you would make off that property. For this property, generally speaking, Kiwis buy stuff that has a little bit of ability to add value. So if you are looking to grow a portfolio and you have no property and you're looking at getting your first, something that you can put some time, effort, work, money into and really increase the value is a good place to start. Although at the moment, just with house prices the way they are, A lot of Kiwis are also going into those sort of townhouses as their first home. For a townhouse, you're just relying on the value of the market increasing because you can't really, there's not scope to add value to the property. If you are looking for your first property and you have a low Kiwisaver deposit and a higher income, you can potentially buy an investment property as your first property. You just need to keep in mind that you can't use your Kiwisaver for an investment property. So, you know, you'll get rental returns. So if your income's a little bit lower, there's that sort of stuff. But it is an option for your first property, but just keep in mind the some of the catches there. For your second property, for customers, that's usually cash flow focused. So what happens is, you know, people hold that first property for sort of 2 to 3 years, maybe even a little bit longer, 4 or 5 years. They use the equity in that property. So the value of the property, subtracting the value of the mortgage, and then taking into account any loan to value ratio restrictions in there, that'll leave you with equity. You can use that equity to then purchase another property. So to keep the LVR lower or low enough to fund it through a bank, that usually is a cash flow focused property as opposed to a capital gains focused property. The reason for that is your income level is probably not going to be substantial enough to just continually buy capital gains focused properties, especially with lending conditions the way they are. Now, more often for not, these days, these are new build properties. There are reasons for this, such as they require less deposit. If you buy a new build investment property, you can get it for as low as 10% deposit in some instances, generally 20 these days though. If you buy an in situ existing property, you'll need a 40% deposit for that property. That is a fairly substantial amount of cash or equity to tip into that first investment property. The other reason we buy new builds is the first investment property. They have a 5-year bright line as opposed to a 10-year bright line test. A bright line test is whether or not you're going to pay tax on the capital gains when you sell the property. New build property, that's a 5-year time you have to hold it for. In situ investment property, it's a 10-year time you have to hold it for before you hit that, or before you run out of that bright line. And then the interest is a deductible expense on your from your mortgage cost. So you can deduct the interest that you're paying on the mortgage or a portion of it against the profit you make on that to reduce the profit when you're doing the accounting at the end of the year. I probably don't need to talk to Xero about that. Hopefully all of you know about that sort of stuff. Once people build up that first property, that second property, they then start to get into a property portfolio situation. Now, arguably, you probably should be talking to a broker for your second property, at least, if not your first. But definitely when you get to the property portfolio stage, you should be talking to a broker or a specialist about where you're putting the lending, why you're putting the lending in those particular places. Split banking is a really popular thing in the market at the moment. A lot of podcasts and property specialists give this advice. You need to split your banking straight away and do all these sorts of things. It is a strategy that if you execute too early will mean that you are less able to, or you're able to borrow less money overall because you will have used up the credit policy at each bank too soon. You want to be really particular about where you're putting the lending and why you're putting the lending there. We start with the first tier banks, so the likes of ASB, Westpac, BNZ, these guys, and then we can move on to second tier lenders as well, specialist lenders, Resimac, CMFL. There's a whole crowd of people who do specialist investment lending. You can focus on growth or cash flow depending on the mix in the property portfolio, but again, that's going to come down to some specific situations. Start to look to diversify with regions. I'm not talking about diversifying as an asset class. I'm just thinking about, you can look at cheaper houses in Christchurch than Auckland, or, some of the regions and that sort of things. You will also get bargains out there in the market. If you do enough research, you will come across a bargain, not eventually, but sooner rather than later. Especially with credit policy the way it is, we are seeing some people who purchased homes 12 months ago and they need to settle them now, but because the credit policy has changed, they now are essentially unable to get the lending to settle that property. We're seeing a lot of investors looking for these properties because they can essentially buy it for the price it was 12 months ago without the capital gains on top. Oh, James.
I accidentally stopped sharing my screen.
You did.
You keep talking, Mike, and I will.
Okay, cool. So the other thing to consider when you're looking at investment property is the type of house you're buying. So you will generally speaking, you've got apartments, townhouses, and the just standard in situ freehold classic Kiwi house. Now, I'll just run through a couple of pluses and minuses for each of these, just to when you're considering, potentially what to buy. Apartments, look, generally the cheapest option because it's not a grounded security. You don't own the ground underneath it. You just own sort of a shared stake in the whole thing. Be mindful of the body corp fees or any other associated fees that come along with apartments, or some of the body corp rules and these sorts of things. You're going to get less capital gain out of an apartment than you would out of a townhouse or a house. This is probably more of a cash flow investment as opposed to a capital gain investment. They'll be good locations. They're usually close to city center. They'll be fairly easy to tenant out. You will get shorter term tenants in there though. So, they're not going to be a family that's going to stay there for 5 years, 10 years, these sorts of things. Likely to be young professionals, students, people who are working or studying, in the CBDs. The other thing to keep in mind, the size restriction. It's generally speaking got to be over 50 square meters. Otherwise you start to run into a whole lot of issues getting funding and finance and these sorts of things. And then my one rule with this is please, please, please avoid leasehold apartments if you can. I've never seen it end particularly well. If nothing else, you end up in a scrap with the people who own the land underneath you eventually, and it just costs money. Cool. Townhouses, great entry-level option. A lot of new builds in the market at the moment. And like I sort of covered in the previous slide, these are attractive for a number of reasons, which can improve the return on investment that you get. They will have some body corp or housing association fees, usually not as high as apartments. They should be in a good location. So what you're looking for with these townhouses as investment properties is somewhere close to the city centre, good to transport links, and generally speaking, somewhere where people want to be. But that's sort of becoming harder and harder to find as there's more development in the major centres. But again, that's the sort of key things that you are looking for with a townhouse. You'll get short to medium term tenants, most likely young professionals, people saving up for their house themselves. It might last 1 to 2 years. You can command a little bit more rent out of these people because they usually have a higher earnings potential as well. And you can go as low as 10% deposit on a new build. So that's sort of the townhouse thing. Now, in situ, classic Kiwi dream house that already exists, it's probably going to be the most expensive option of the lot. There will be the ability to add value, or there should be, but you will pay for that. So you'll be paying for the land underneath the house and any potential ability to add value. A really key example here is if it's a large block of land, you're going to be scrapping against professional property investors and these sorts of people who want to subdivide the land. Maybe a little bit further out from the city centre, you'll get longer term tenants, so families who want to stay in there and that sort of thing. So those are the different sort of property types in the asset class. There's commercial and other things. I won't go into that because that's more specific, but what does it look like on a capital gains comparison? Now, what I've got here is Auckland and Wellington and the comparison across houses versus townhouse units and apartments. It is fairly obvious here in the data around what you can expect from a capital gains perspective from that investment. Look, houses and townhouses or units track all things pretty closely. There's not a huge amount of difference there. Yep, it looks a little bit more dramatic than it is in Auckland on the screen, but because of the entry point for an in situ house versus a new build townhouse, still a really good investment with the capital gains you're getting. Again, you can just see it here. The apartments are not giving you the same capital gains growth that you're getting across the other two property types. So just think about it as a different investment. It's a cash flow investment as opposed to a capital gains perspective. But ideally, for your average investor, to start off with, you're probably going for a townhouse, a unit, or an in situ house. Cool. So is residential property the best asset for retirement? Kiwis love property. We talk about it constantly. It's on the news every night. Everyone wants to be a property developer. It is pretty crazy. But think about the asset class and what it means for you as you move into retirement. During retirement, you are going to turn off your active income tap and start turning on your passive income taps. Now, a house is great, but you might have $1.3 million tied up in this house, and it might be giving you, I don't know, $700 a week, $600 a week, $800 a week, something like that. And then if you want to go on holiday, you can't just sell off a bedroom of that house to, spend the money on holiday. It's not a very liquid asset. There's high, they are easy to sell, but there's high transaction costs involved, and you need to sell the whole thing. So if you need money in a hurry or for a specific purpose at a specific time, it may be that you have to sell all of the asset at a time where it's not optimal in the market. So just think about that mix as you move into retirement. It's a great investment, or traditionally has been a great sort of investment asset class, because you're using the bank's money to leverage up to get you that investment. But think about that mix as you move into retirement. You may want some more liquid investments.
Just a reminder for everybody on the call as well. Let's get some questions going. Please pop them in now so we've got some to answer as everybody else throws them in. Mike, before we jump forward, let me just ask you a question. Say I'm 35 years old. I can invest in shares or I can invest into property. What should I do?
Well, I'm a mortgage broker, so you know what I'm going to tell you to do.
Why?
Shares or property? I mean, again, I'm going to need more information to give you some advice, but generally speaking, I'd probably say property. You've got a long time to hold that asset. You're probably asking me for specific advice, James. I'd need to know more information. How much do you earn? What's your current debt position? Do you have any other houses?
What's special about property as an investment? Like what makes it?
Well, it's the ability to leverage using someone else's money, right? Because yes, you can leverage with shares, but the volatility, and you can leverage with crypto as well, but the volatility in that market can potentially mean you get stopped out of a position. Whereas when you're leveraging with the bank's money for a house, it's generally a smoother ride. You're not getting the big ups and downs. The bank isn't going to, stop your position or call a loan in. The other thing to sort of think about is, if the price of a house drops and you've got tenants in there and they're still paying the mortgage, at least for a while, you're going to be okay. This is an asset, that you can live in. If you're buying a house and you want to return out of it, you can actually live in this asset. It gives you somewhere to live. Very hard to live in a share portfolio.
I think especially if you're in a situation where you've got a mortgage, you don't have any kind of cash outside of your mortgage. With investment property, you can turn nothing into maybe a $500,000 or $1 million asset. And if that's delivering a 5% capital gain over a long period of time, that's quite attractive in that situation. The other piece you need to, keep in mind is interest rates are rising, we're seeing at the moment, and rents haven't kept up with houses going up in value. So you're going to take on a bigger mortgage to get the same house and not get the same rent. So you just got to make sure that you're going to be okay in that situation, that you're going to be able to fund the any top ups that are required. And that's really important, because a lot of people are just like more property, but you just have to think through it, make sure it's right for your situation. The tricky thing with investing into the share market when you've still got a mortgage is there's the opportunity cost of paying off the mortgage. So if you make a 7% return on a share, but then you are paying down, you've got to pay tax first, which maybe that brings you to 5%. Then you take off inflation, that gets you to 3%. You compare that to a mortgage rate, there's not a big difference. So that's one of the reasons I think of kind of property versus shares. But certainly when you get towards retirement, conversation changes, because I see a question here is, what is a liquid investment? Very good question from Harms. A liquid investment is essentially something where you can sell it down, or you can get your money quite easily. Property is not a liquid investment. As Mike said, you can't sell a bedroom to go on a holiday.
Crypto, cool. Everyone's favorite topic at the moment. We should throw something in here on NFTs. The amount of times people are asking us about NFTs as well is pretty crazy. So look,
we're going to do a podcast on NFTs soon.
We are. So look, what I'm going to do here is run through some really basic comments. Full disclosure, both James and I hold cryptocurrency, but we are by no means cryptocurrency experts. We know that. We've met people in the market who are. That's not us. We don't usually give advice on cryptocurrency. We just more provide information and then some parameters around what people should or could look at as options. Now, if you are looking to me for what cryptocurrency is and a description, you probably shouldn't be investing in cryptocurrency at all. James, next slide. So look, a cryptocurrency, decentralized token or asset that you can use as a store of value for exchange for goods. A lot of the key features of traditional investments are now available in cryptocurrency investments, like your leverage, you can get interest, liquidity, but there are transaction costs to consider as well. So look out for the gas on these sorts of things. But again, if you're coming to me for what a description of it is, potentially don't consider it as an asset class to invest in. You need to do a lot of research on it about the specific currency you are investing, how you're investing into it, how you're storing it, all of these sorts of things before you just dive in head first. Now, a lot of people look at this as sort of a Hail Mary or a long shot, right? Like, yeah, I don't know, maybe I've got some in a coin I think is a relatively good investment, and then I've got some stuff down the bottom, which I found in a Reddit forum. I'll chuck $1,000 in there, and if it pays off, I'm the next Mark Zuckerberg. I'm huge, I'm rich. If it doesn't, I don't mind losing the money. These are all decisions you need to make when you're
hopefully
thinking.
not. Sorry, Mike. Hopefully not the next Mark Zuckerberg where you've lost a quarter of your net worth in a couple of days.
Yeah, true. He's still doing all right, mate. Don't worry. Now look,
he can pay for lunch.
Yeah. All of that is fine. You just need to consider it with your wider financial position and just think, what happens if this all goes to zero? Now, this is the Bitcoin price recently. You can see there's a fair amount of volatility there. In the previous slides when we've done this, it's been down to like 11,000, then up, then down, then down. So just think, absolutely, volatility creates opportunity because there's swings, so there is a while up, a while down, these sorts of things. But you need to be investing an amount that you are happy with just generally completely losing, because you do see some really sad stories about people remortgaging the house, going all in, and then it not going so well for them. Cool. Couple other things just to consider on the logistics side. Think about the merchant or the exchange that you're using to facilitate these transactions. Even the big guys like Binance are under investigation by the SEC and this sort of stuff. But there's a number of different players out there in the market for that. Easy Crypto, Coinbase, Kraken, these sorts of things. But just really consider and do some due diligence on who you are. I guess this probably comes into the online storage or the hot wallet stuff as well. Do some due diligence on the people you are choosing or the companies you are choosing to store your crypto, and then do the transactions as well, because a lot of things can go wrong in that space. Absolutely having an online storage is going to make it easier to trade a little bit. But obviously that cold storage, that offline storage is probably the safest. But again, remember that cold storage can also get stolen. There was a case in Auckland recently where a couple had moved out of a property because it was being renovated. They had left their cold storage hard drive in a safe in that house. That then got stolen, and now they've lost that investment. Well, they're actually I believe they're trying to negotiate to get it back at the moment. So nothing's 100% secure. Just consider that when you're looking at your logistics and your security. Cool. Logistics and security part 2. Now, there are a million different scams out there for cryptocurrencies. I've got a list here, and yeah, Mt. Gox is at the top. Probably not so much a scam, just something that got hacked and is now unable to get your crypto out of there. But even if you think about Mt. Gox, it stands for Magic the Gathering Online Exchange. That was originally built to trade Magic cards, not to store cryptocurrency. Just again, do some due diligence on the companies you are using to do the transactions and trades. Other things out here, you see social engineering scams all the time around people, taking wallets and taking payments and these sorts of things. I probably don't need to go into that too much. You know, ICOs and DeFi rug pulls, you know, you invest the money, it's there today, it's gone tomorrow, and there's nothing propping up. There's nothing really propping up the coin. We've got a friend of mine who works in this space, and he sort of reasonably estimates that half the projects he works on ends up being a rug pull or a scam of some description. Obviously, he doesn't know they're scams at the start and exits when he finds out, but you know, it is super common. The one last thing I will say is remember where you bought stuff and remember your passwords and your keys. I was sort of saying at the top of the webinar that I had a story about this. So I got invited to participate in an ICO for a coin called MetalPay. I think it's like MTL or something is the name. I can't, for the life of me, I can't remember if I bought it at 1.4 cents or 14 cents. But I think I chucked like £1,000 at it or something. It's trading at $1.70 US today. I have no idea where that is. I have no idea how to get to it. I don't know what the password is. Like, it's completely gone. So just, you know, keep all this stuff secure. Don't make the same mistake as me, although it's super easy to make. And lastly, why? Why are you investing in this asset class? Is it because it's the fear of missing out? Everyone else is investing in it. Is it just a Hail Mary where you're happy to chuck $500 here, $1,000 here at stuff and just see if it pays off? Or do you fundamentally believe in the underlying principles and technology of what you're investing in? Really consider the why, and then the appropriate investment when you are looking at this asset class.
Yeah, it's probably the biggest piece for me is the why. Why are you investing? Is it you got a hot tip from a mate, you don't really know what's going on, or is this, you know, decentralized currency, crippling the banks, bringing them to their knees, if that's fundamentally what you believe, a different kettle of fish. Kiwisaver. So we'll quickly touch on this. I said last time that in yesterday's webinar that it is pretty crazy that, yeah, I think your income is your biggest asset. And then outside of your income, when you get to retirement, Kiwisaver is going to be either your biggest asset or right up there. So if you're earning decent money, you might have hundreds of thousands of dollars, or maybe even over $1 million by the time you retire. There's still like a third of Kiwis that haven't made an active choice of their Kiwisaver. So we call this just making sure that you're supercharging it. So what provider are you with? What fund are you in? And what are your contribution levels? Now, as a minimum for the contribution levels, you should be making sure that you take advantage of all of the your employer's contributions and the government tax credit. The fund is making sure that you're completing your risk profile and understanding that whether you're conservative, moderate, or a more aggressive fund. And then a provider. What do you want from a provider? If you just want a provider with the best returns, historically, that's easy to work out. Looking forward, a little bit more complicated. Is socially responsible investing important to you? Do you want a provider with a really good app and reporting tools? Do you want a provider that's New Zealand owned? Do you want a provider who the fund managers invest where you're investing? Do you want active investing, passive investing? I can see there's a question here going between active, passive, direct investing. Where would a Kiwisaver account typically sit, and can you shift that? Great question from Avinash. You can shift your Kiwisaver to a whole bunch of different providers, and it's very easy to do. So your passive providers would be like a Simplicity is the big one. There's another one, Superlife. I think Superlife's the other one. There is a lot of active investing ones. Some of the bigger ones are Generate, Booster, Milford. Some of those fees can be quite high, so you just want to look at the performance after fees. Direct investing is something that is not particularly available. The best bang for buck, if you wanted to do that, was probably going to like an Invest Now. Invest Now, you can choose the funds that you're investing into, but you just want to have a real good think whether that's the road you want to go down. And the reason I say that is self-managed supers are very big in Australia, but the numbers speak for themselves that self-managed supers perform worse than just a regular fund. So why are you going down that specific investment strategy?
James, what's a super?
Oh, it's like a Kiwisaver. So it's a locked-in pension scheme until you hit retirement age.
So self-managed Kiwisaver.
Pretty much.
Whew.
And just to bring home the point of why it's so important to pick contribution levels and the fund that you're in, and then if you overlay over the top good providers versus poor providers, you can see, and I'm not completely detached from reality, although some might say that from time to time, a 20-year-old is not earning $80,000. That's their average income across their working life. But you can see from $500,000 to $3 million, there's a big difference. Now, that doesn't mean, go on, Mike.
No, nothing.
Mike's got a standard joke he puts in here going, I'm all in on aggressive at 10%. But you need to be comfortable with the volatility, the ups and downs that these funds offer if you're going to take more risk. And obviously, you might take your contributions that would go into, like, say, 10% or 6%. Maybe you can put them somewhere else that's more liquid and available that might work better for you. So more here doesn't necessarily mean better.
I feel like that's an aggressive 10% suit that you're wearing today, James. Cool. So key points from today. Guys, try and time the market. Pick the fund, pick the stock, pick the asset class. Iron butterfly spread to the moon. No. Investment strategy should align with your goals, your time frame, your tolerance for the risk. We're talking about long-term investing here. Again, think about that diversification. It's key. You know, I sort of talked about a little bit of diversification in New Zealand property market. It's not real diversification from an asset class. It's just picking, you know, I guess different regions that you can invest in. But when people are selling you diversification, think about what they're actually talking about, and if they have a vested interest in selling you one asset class and not diversifying properly. Pick your property type. This can make a really big difference in terms of the return on investment that you get, how easy or passive it is to manage, the weekly, monthly, fortnightly cost, all of these sorts of things, and ultimately the capital growth you're going to get as well. Invest for your stage of life. If you are 4 days away from retirement, should you cash in everything and throw it all on a cryptocurrency? Probably not. You know, think about, again, it comes back to that timeline, that goal, and your risk appetite as well. Invest for the right reasons. I'm not saying that throwing, you know, a couple of $100 on a Hail Mary cryptocurrency or something like that is the wrong reason. So long as it is sort of right to you and it fits your personal investment strategy. Again, time frame, tolerance, risk, and goals. And then think, look, if wealth is like a snowball, get rich quick schemes like an avalanche. Everyone wants to get rich quick. That's why the lottery is so popular. But look, we are about investing for the long term, small incremental steps, building that wealth over time. That's what's going to get you there.
So we are about to do some Q&A. If you would like to have a chat about your own personal situation, in the description of this video, there's a link to the mortgage team's calendar where you can book a time to talk to one of the mortgage team about investment property, or maybe even meaning to book a one-on-one time for talk about your first home, or you need your renovations, or whatever it might be. There's also a link to the wealth team's calendar. So that might be to talk about investing, like we've been talking about today, maybe looking to build a financial plan and go, here are my goals, here's what I'm trying to work towards, what is the right split of assets, and what do I need to do to achieve that more effectively. So there is the link in the description if you want to do so. While you are finding that link, writing your questions, hopefully furiously, for us to answer in the live Q&A in a second. In this channel we're in, it'd be great if you gave us a subscribe, not for us, but for you, because there's 70-odd videos in here which talk about some of these concepts in a lot more detail, some really good guests that we've had on here as well. So making sure that for the Money Bites series, that you're listening to those and taking control of your future and learning about topics. Money Bites explain jargon, finance jargon, like, for example, a liquid investment, which I think you and Mike just wrote down.
Yeah, it is.
All right, Mike, Q&A time. What have we got?
Cool. So These are probably all going to be in your wheelhouse, which is great for me. In the current economic climate, investing for 5 to 10 year time frame, how would you hedge considering the broad asset class overpricing we are seeing?
Yeah, thank you for the question. It's a good question. It is kind of going, what are the hot tips? Where should I be investing? And if part of that is where should I be investing to mitigate some of my risk? If you're investing for a 5 to 10 year time horizon, it is highly likely you'll experience volatility at some point. The other thing, which might sound a little bit mean to say, but is true, is negative returns aren't a bad thing. It is healthy for the market to correct. It creates opportunities where you can buy things at a discount. So if you're investing into any asset class, trying to avoid negative returns over a 5 to 10 year period, it's very difficult to do so. So my encouragement would be more making sure you're investing in line with your goals, making sure you've got good diversification. Some people like to invest in direct companies, and that can create quite a bit of risk. If you don't have if you're holding 10 different companies, at least that's some diversification. But what's going to happen next? Real answer, I don't know. How closely do I watch the markets? A little bit, but I'm all about long-term investing and make sure we've got diversification, because it's not if those bad times will come, it's when.
Isn't the like a quarter of the S&P 500 made up pretty much of 10 companies anyway? Like,
yeah, there's a great picture of like the split of them, and there's some pretty big dogs in there.
Yeah, like I'm pretty sure I remember seeing something the other day, and it was like the rebound from the S&P 500 or the bull run from the S&P 500 is pretty much those 10 companies. They're most of them are tech, excluding like Johnson & Johnson or Tesla, or something. Arguably Tesla's a tech company. And they are the ones that actually had the snapback and the bull run, and everything else is pretty much just along for the ride. Anyway, there's some talk about index funds and ETFs being oversubscribed and a bubble forming or has already formed. Is that a perspective you give much weight to?
That question is an absolute banger. I have seen some stuff in the Reddit forums about this. I don't mean to dismiss the question. It is generally a good question. I don't think it carries much weight. I'm not concerned about that idea, but it's definitely an idea I would need to do more research on to draw a conclusion.
I would love if that ETF bubble popped tomorrow and there was a comment under this like, I told you so. Cool. Between active, passive, direct investing,
already answered it.
Have you? Okay, cool. How do you know it's the right time to take out your shares?
Great question. So the right time to take out your shares, assuming that you're in some sort of diversified strategy and not just all in A2 milk. I'm still waiting for my A2 milk shares to recover, and she's been a long journey. When is the right time to take out your shares depends on why did you invest in the shares in the first place. So if it's retirement or buying your first home or something like that, potentially you never sell your shares. Potentially you're getting paid a dividend on those shares, or if you're in some kind of fund, you're slowly selling and depleting your capital over time. So the obvious question is, if you're going to sell your shares, what would you do with the capital instead? Is it income-based? Is it to pay down another investment? Is there another opportunity? So a really good question, but a difficult one to answer. The thing I would say on top of that, though, is what is happening in the market should not be why you buy, or potentially buy shares if it's a discount, but you shouldn't be selling shares based off volatility, because just part of the game.
Cool. How do you build a robust investment strategy?
Making sure it's aligned to your goals, making sure it's well diversified, making sure that it motivates you to work towards the lifestyle and the dream that you're trying to build. So Kiwisaver is a good one. So a diversified investment strategy, a robust strategy, should start with your income. So yesterday we spoke about income does not make you wealthy. Income minus expenses, the leftover amount, that is what makes you wealthy. So Luke gave a shout out for using the Xero subscription you will have to understand your expenses and your budget. So the first part of a robust strategy is going, how much money have I got to allocate towards investments? And then obviously that's going to be a split of investing into index funds, direct shares, managed funds, depending on what's right for you, potentially investment property. Paying down debt is part of a strategy. So if you've got high interest loans, obviously they're the first thing to go. If you've got a mortgage, the whole do I invest versus do I repay? And then it's bringing it all together and going, this is what all of these widgets and these moving parts mean. What does it mean for me over 5, 10, 15, 20 years?
Yeah. Cool. Talking about buying a first home, then getting a new mortgage for an investment property, I'm assuming there's an element of being comfortable with holding a large amount of debt over a long period. Just before I answer this, we're starting to run out of questions. So if you do have any more, chuck them in now, because we have a bit of a delay from what we're doing to the YouTube. So just put them in now so we know to answer them. Yeah, absolutely. So there's really two different types of debt when we're looking at debt for property. Your owner-occupied property debt, so the house you live in, that it's not bad debt so much because you need a house to live in, but it is debt that we would advise you to continue to pay down. So we wouldn't be putting that on interest only and having you not make headway on paying that debt off. Your investment property debt is a little bit different. It's good debt to a degree, because that is debt that is going to be earning you a return over time. So yeah, absolutely. There is an element of having a large amount of debt, but we sort of compartmentalize it a bit because there are different types of debt. But it's just about what you're comfortable with. The other thing to remember quite often is if all else fails, we look at selling the investment property first and clearing that debt down, so you're just left with the debt on your owner-occupied property.
Yeah, I love debt. Do you know what else I love, Mike? This next question. Which Reddit forums do you guys read?
Heaps. I read none for investment advice, I can tell you that much.
Yeah. I mean, that's probably the thing with investing in general, right? Is now there is just so much information to build any sort of argument or point. And it's just like there's so much information on, how to diet and how to lose weight. And a lot of people still don't find the right mix. So I'm personally not a Reddit guy, but Mike is deep in those forums. MYKB 2022.
Yeah, cool. Cool. So the last one we got on here, not just in the milk. Yeah, I know we keep bringing up A2 milk as an example just because it's a good one, but we know that that people are investing in other shares directly. James, I don't know if you dropped the stat around what percentage of those portfolios make money, direct investments?
Active. Those that are actively trading their portfolio, 3.4%. Make a large enough return to make it worthwhile.
Yeah, it's the stats aren't great.
No. So it looks like we're out of questions. We have had an absolute ball with Xero this week. We look forward to talking to some of you one-on-one. Please give this channel a subscribe and like the video so you can come and check out more of our content to help you take control of your financial future. And hopefully we talk to some of you in the near future.
Yeah, there'll be an email that comes out after this, like we said at the top of the webinar, that will have links to our calendar invites, also to a survey. Please fill them out. We love getting the feedback. It helps us make these better. You can also find the links to